Hello, everyone. Welcome to CryptoDefined. My name is Kathy Chu, and I'm your host for this bi-monthly news interview series where we look at the innovators, the detractors, and the skeptics of the now less than $1 trillion crypto industry. CryptoDefined is produced by TruthDAO, a new nonpartisan journalism organization within a DAO. You can visit us at truthdao.xyz and join our Telegram and Discord communities for more information. Today's guest, we have the pleasure of having Stephen Young here with us. He's the co-founder of NFTfi, spelled NFTfi, NFT collateralized lending platform. Before NFTfi, Young also founded CoinDirect, a cryptocurrency exchange and OTC desk. Stephen has been building and designing software for banks, financial institutions, and fintech startups since 1998. Joining us live from South Africa, Stephen Young. Thank you, Stephen, so much for being here today. We really appreciate it.
Hi, Kathy. Thanks for having me. Glad to be here.
It's such a crazy time to be chatting, but it's fortunate that we're able to talk to you because you have this depth of background and can comment on some of the events going on today. So let's start, if you don't mind, with the elephant in the room, which is the FTX collapse and some of the ripple effects we're seeing now. Stephen, you previously founded a cryptocurrency exchange, so I suspect you have an interesting view of what's going on and what's happening. How are you thinking about FTX's collapse, and what are the lessons here today?
Yeah, I mean, so I think, one of the important things to kind of remember here is it was pure financial fraud, right? So, there was nothing kind of inherently crypto in like what Sam did there. It's happened a million times in a million different industries. I think one of the big lessons here is, this is the kind of thing that happens when you've got vague or unclear regulations. So the reason FTX was able to kind of really gain such a market share is because legitimate companies, like Coinbase and other like Kraken, people are trying to play by the rules, just couldn't offer some of these products. And there was no clear guidance from the regulators. So people are kind of forced to go off overseas and go like deal with these companies that are kind of not regulated, without a board, founded in the Bahamas, no oversight, because there aren't kind of well legislated options, in kind of the in the US and also not in the UK and Europe either.
Now, you mentioned fraud. Obviously, there's a lot that's been alleged there. Just to be clear, nothing's been proven yet. But your concern is that at the end of this, there may be some financial shenanigans that may be discovered. Is that correct?
Yeah, I mean, we saw the initial filing from the CEO kind of doing the restructuring at the moment, right? And so there's, it's clear that, like there was no segregation of funds. They didn't keep track of even where the bank accounts were, no accounting. In his words, it's the worst he's seen, and he did the Enron unwind. So so I think it's pretty bad. But like I said again, this comes from kind of having these people having to operate in unregulated jurisdictions and not having a clear set of guidelines that they can kind of just go and follow, and you can have actual legitimate players, that are following the rule of the law. It's just they aren't real kind of clear guidelines and rules on what that should be.
And Stephen, you have experience having founded an exchange. I mean, some of the things you're seeing, would you say they're extremely unusual for an exchange practices? Some of the things that are trickling out. I mean, obviously the details are not clear, and we're getting more and more information every day. But just from your background, is this very out of the norm, I guess, even for a cryptocurrency exchange?
Yeah, so I mean, I would have said it was out of the norm, not so long ago. I mean, there are, typically there'll be like a few top tier exchanges in each jurisdiction. Normally, kind of the ones that are like playing by the rules, and then there's kind of a few little not as well-known players that are kind of playing on the fringes, like in those players, sometimes it's a little bit more common for people to do these kinds of moves. I wouldn't have thought a top 3 exchange was as bad as it's looking like FTX actually was, and so I think it's probably more common than like you would expect for people to do some small things like this. To the extent of FTX, I think that's pretty uncommon that it's so rampant and so kind of pervasive throughout the organization. But for the big players, like Kraken and Coinbase, and a few of these other kind of really legitimate brands, I think you're pretty safe. But there are a lot of unregulated, dodgy players in this space.
Right. And just to be clear, you're no longer with CoinDirect, correct? You're co-founder of NFTfi, and you were with CoinDirect, but you are no longer with them.
Yes, correct. And part of the reason was because of, in the exchange world, you're still dealing with, this, you're holding other people's assets, and you have to put these measures in place because essentially they need to trust you to hold your assets. And with NFTfi, for example, we don't have any access to anybody's funds. It's all mediated by a smart contract. We can't reach into any of those loans. Those NFTs are never recoverable by us under any circumstances, which in some cases makes our life more difficult in terms of customer support and user support. But we just don't want to be in the situation ever where it's even possible for us to think about doing something like this. And that's, kind of think that's the real power of self-custody, decentralized finance, is that, you can never get into the situation that you got in with FTX. So FTX repaid all of their DeFi debt already. All those DeFi protocols got their money back. It's all the centralized players that are losing their money because there's no way to get out of a smart contract once you've signed the transaction.
And Stephen, you mentioned that NFTfi came as an idea you worked on during the pandemic, and obviously you wanted to go forth with it, but also you made a conscious move from CeFi to DeFi, from centralized finance to decentralized finance. Why is that? What was the motivation for that?
Yeah, so I think it's this combination of this giving people like the power back to kind of to take control of their finances, and not not having to trust the third party with your actual funds, and kind of having spent most of my career working inside regulated financial institutions, asset managers, banks, all those kind of things, and then spending some time in an exchange. It becomes really difficult in those organizations to do anything new or innovative just because of all of the rules that are rightly there. Like as soon as you are holding somebody else's funds and you've got the option to run away with it, you need to have regulation and oversight for that to be safe for consumers to use. And the thing is, it's always difficult for regulators to keep up with how fast things are moving, and it makes things like building fully global, fully inclusive financial systems like just more difficult because it takes longer to move. Like it's like a giant tanker ship that you're trying to move. It's just really difficult. And then you see these kinds of things, like this implosion of lenders, like this happens all the time in the traditional financial system. It's not just in crypto that it's happened. It's, this was spectacularly big and to, a massive degree. But these kinds of things happen all the time in, Lehman Brothers collapsed, this stuff happens. So on the other hand, in DeFi and decentralized ecosystems, you can kind of design these systems, and maybe sometimes, some of them break, but once you've designed something that works, it just carries on working, and there's no room for somebody to kind of come in there and steal your assets. And I kind of like that trustless nature of the ecosystem.
And I think the last time we talked, I don't know if this is the exact word you used, but I think you mentioned something to the effect that with DeFi, there's less of a headache. that's partly why you moved into it. Is that correct?
Well, I think it's like, I mean, you swap different hit for a different headache, right? So in centralized finance, the headache is kind of complying with regulators. In decentralized finance is making sure that your system is secure in this completely open world where it can be attacked at any point by anybody. So at NFTfi we kind of regularly deal with hacks and people trying to attack us, and like you constantly having to carry that risk. And I think the other risk, which is ironic, is your other headache is not having any regulation, because you don't know what you're allowed to do and what you're not allowed to do. So it's really difficult kind of navigating that space where you're trying to do things that are good for your clients, but you don't really know how the regulators are going to see this, and they don't give they don't like provide rules. They just create they just basically litigate and prosecute people after the fact. They don't tell you beforehand what you're supposed to do, so you just swap your regulation headache in a slightly different way, I guess.
Okay, fair enough. Now, you made a very good point that I think everyone should keep in mind with all these collapses in the crypto world. It's not just crypto. It's Lehman Brothers. You've seen a bunch of collapses. You've seen bank runs since the beginning of banks in the traditional finance world. One thing we are hearing with the collapse of FTX, though, I have heard a lot in the crypto sphere that if this was DeFi, this wouldn't have happened. And you made the good point that SBF and FTX had to pay off their DeFi obligations first, right? Because it's smart contract. But I wanted to ask you a little bit more about that, because in terms of the collapses this year, we did have the collapse of the Luna Terra ecosystem, which is a DeFi ecosystem. So how should people think about this, Stephen? Because I think people are hearing somewhat conflicting things. This would never have happened if it was DeFi. However, then you have to consider something like Luna Terra, which collapsed spectacularly, and some would argue was the launching point for some of these collapses, possibly even FTX, which we don't know yet. But there's some links to FTX that the troubles could have started there. So how do you think about this? How do you get it, wrap it around your mind?
Yeah, so I think when people say things like this would never have happened in decentralized finance, I think what they're talking about there is this very specific thing. What that happened with FTX is where people gave FTX their money. FTX promised not to use that for other things, but they did, right? So you kind of handing your money over to somebody else, and you like trust them based on a promise that they won't do it. And then they've got opaque internal systems where they get to do all of these shenanigans without anybody being able to see it. Now, in a decentralized finance, everything is transparent. So you can see the code, and the code can be verified before you actually do the transactions. There are audit firms that do this, so you can, even if you can't read the code, you can kind of trust some third parties to have done that. And then once you've moved the money there, everything is transparent and open. So, if people start moving things in ways that, they said they weren't or they weren't supposed to, that's traceable. And you actually saw that happening when the hack was going on with FTX. People were seeing that the hack was happening, and they were tracing where the money was going. They know exactly which address. They don't know who the person is, but they know what the address is doing. They know it's turned it all into Ether. So you just have built into the way decentralized finance work is you don't have counterparty risk. So you don't have to worry about the person that you trusted to do something with your money doing something that you didn't agree to. And you can see actually what's happening on chain. So if somebody says they've got $100 million, you can check if they've got $100 million. You don't have to trust them at all to kind of do that. You can always verify. Now, that's not why Terra Luna went under. So Terra Luna, it gets very complicated. So I won't go into the kind of the technical details, but it was in the way that the system was designed. There was a scenario where if the price started dropping and they tried to kind of kick in this mechanism that would print more of their own currency to prop the price up, it was, you could kind of mathematically prove that under those conditions it would have gone to zero, right? Or at least get very clear indication that that would have happened. So it's a different kind of problem. So there's not that there's no risks in DeFi. It's just that there isn't a risk that you give your money to somebody who says they're going to do X and they do Y instead. So I think that's a very important distinction to make.
No, I appreciate you clarifying that. Okay, want to get into the nitty gritty of NFTfi, but one last question about just the market events right now and the environment. Last time we spoke, you made an interesting point about how FTX's collapse and just the contagion surrounding it and everything else that's happened this year could affect venture capital and startups. So I wanted to ask you, in what way could this affect just the VC and the funding? And has NFTfi personally noticed just more scrutiny of nascent companies in the space since this has happened?
Yeah, so a lot of funds and VC funds, there's a couple that have gone under already. I'm sure there's some others that had at least some loss. So some of them had their funds with FTX. I'm seeing kind of these new exchanges that are kind of running into troubles. And you see the Gemini Earn program has been paused. That's another fallout. If Gemini that now also starts having some financial issues, a lot of funds have money with Gemini. So I think there's just a lot of kind of collateral damage. The funds that had $100 million, maybe now they've got 70 million left, right? So there's just not quite as much money going around. And then, yes, during the peak of the bull run, people would, anonymous teams would raise money based on, a Discord and, some early sales of an NFT, right? So, there was pretty gung-ho at the time. Everyone was just throwing money at projects to kind of get in. That changed already before, as soon as the market kind of turned and there wasn't, so much FOMO in the market, it was already starting to become more difficult and people were doing more due diligence, not chasing to kind of get into the hot round. But I definitely think all of the LPs of these big funds are going to be saying I see that the poor Canadian Teachers Union got caught in pretty much every single one of these things recently, right? So they're going to be asking very difficult questions from the funds that are allocating money for them. So that's going to trickle down into the startup world. But in a way, I would say, the funds that were giving, FTX, billions of dollars at a $32 billion valuation when, it's looking like it was a complete shambles inside there. Where was their due diligence? They've also got some responsibility, I think, in this scenario.
Yeah, it's interesting. It'll be interesting to see how much due diligence was done, because you've had some people come out and say, we met with SBF and we decided not to give him funding, but others have said, that he seemed presentable, he had documents. There's just this mismatch in terms of information.
I think to be brutally honest, I think he was just making what it looked like he was just making money hand over fist. And I think to a lot of people, the stream of cash kind of pouring through him was, almost enough due diligence to kind of, make them overlook a lot of the other warning signs that other people have seen. So, the appearance at the time was that he was just making money left, right, and center, more so than anybody else in the space, So I think a lot of people were just blinded by that.
Right. Okay, let's get into the details of NFTfi. NFT lending started off very informally with people doing these loans among themselves, as you've mentioned in previous broadcasts. So talk to me a little bit about this for people who don't know that you can actually pledge loans as collateral. It's still a very nascent market, right, Stephen? You had mentioned that, people have been doing this for years, as long as NFTs were around, which is very young anyway. But now NFTfi has formalized the process. Is that right?
Yeah, so back in say 2019 or so, it was still very, very kind of early. Like Bored Apes didn't exist. I think the most expensive NFT at the time was probably, I don't know, $300 or $400 or something like that. They weren't what are today. But people were, especially in the Axie Infinity community, people were like lending each other money using NFTs as collateral. It was mostly kind of people doing it within a friendship group and with a kind of spreadsheet where they're kind of keeping each other honest. And so one of my business partners, Mads, he was involved in that scene very early on. He was on a big CryptoKitties breeder. So we started talking one day about kind of, he wanted to use his cats to long ether. So he wanted to leverage his cats to long ether. So that sounded like a great idea. We got a hold of the spreadsheet and then basically built the first version of NFTfi to essentially just take this spreadsheet that required trust and tried to create a smart contract that took that trust element out of it, where you could have essentially a stranger offering another stranger money and using an NFT as collateral in case they didn't repay. And so that's what we did. So we've done $290 million in loans up to now. Our biggest single loan was $1 million on a autoglyph. And we also have our biggest group loan was $8 million loan on 104 CryptoPunks.
So talk to me about how it works. What's the average loan size? And this is a peer-to-peer NFT lending exchange. So it's a little bit different from BendDAO, correct?
Correct.
So could you talk to me about, how it works and how this is different from, getting an NFT loan from BendDAO or even FTX? On FTX, I believe you could pledge some of your NFTs as collateral, and then you could get a loan. So how does this differ?
Yeah. Okay. So let me just explain quickly how we work, and then I'll explain how that's different from the other systems. So we're a peer-to-peer protocol, like you said. So say I've got a CryptoPunk, I can come to NFTfi and I can say, hey, I'm looking for a loan on my CryptoPunk. I would then receive offers from lenders, and there were multiple different lenders. They're all making me different offers, all at different interest rates and different values. I would then pick whichever one I think is most appealing to me. So say I take a 10 ether loan, and I have to repay 11 ether in 9 days, or 90 days, whatever the time period is. And then what happens is when I accept that loan, the NFTfi smart contract transfers the NFT out of my wallet and holds it in escrow inside the actual smart contract, and transfers the funding amount from the lender's account into my account. And then I've got the loan period to repay that. If I repay on time, then the lender gets the loan principal back plus the interest, and I get back my NFT. On the other hand, if I don't repay on time, the lender can foreclose the loan, and I keep the money that I received from him, and he takes the actual NFT. So let's first talk about how that's different from FTX. So in FTX, the way that would have worked is I would have had to send my NFT to FTX and given them control over it. And that would have just gone into some internal wallet that they got full control over, and they can move however they want.
Centralized finance. They're centralized.
So it's centralized so they then essentially take custody of my NFT. Whereas with our scenario, the only way to move that NFT in and out of the smart contract is by either starting a loan or repaying a loan or foreclosing a loan. And the rules that govern when that can happen, under what circumstances, are encoded in the smart contract. And that's not changeable by us. So our contracts aren't upgradable. They're there, they can never change. So once your asset is in there, for sure that it'll never move unless you repay it or you miss your actual loan repayment. Now, so that's kind of the we never take custody of either lenders' funds or the actual NFTs. So there's no chance that we could ever steal any of these things. And we've done a bunch of audits to kind of prove that is true. And then, so that's the difference between a centralized lender like FTX, and then in BendDAO, so the way we work is that we match a borrower and lender, and we as a platform don't have any view on what that asset is worth. So we just facilitate the actual transaction. On BenDAO, the way that it works is lots of different people can pool money together, and then there's rules inside the actual pool that they've set up that determines what value they will lend on. That tracks the floor price of the actual of the NFT, and if the floor price drops too much, it'll basically say, hey, your loan is due because the value of the asset has dropped too much. You need to either pay back something or you're losing your asset. So basically, as the price of the asset changes, your loan might become due. With NFTfi, you've always got the full loan period to repay, and your interest rate never changes. It's always static.
And the loan period is typically, I believe, 31 days. Is that correct, Stephen?
That's the average, yeah. So, and that's made up of mostly 30-day loans, some 40, 45 and 90-day loans. And then there's a few shorter loans too, where people just need short-term liquidity for 7 days or something like that.
Okay. So with using NFTs as collateral, talk to me a little bit about why this makes sense, because I think some people have a hard time grasping the idea of NFTs in the first place. I think people who aren't in the crypto world and understanding that, hey, this NFT, it could be a non-fungible token, it could be artwork, it could be a tweet, it could be all sorts of things. But then the additional step of, using this as collateral, considering that the NFT market and crypto just in general is so volatile, how would you say people should think about this? I mean, is a volatile asset such as an NFT a good idea to use as collateral?
Yes. Right. So, okay. So first of all, let's kind of not have two conversations at the same time. So let's just assume that there are some people that think NFTs have value, and some of these people have enough money to lend to other people who have these NFTs, right? So we don't have to get into like why these things are value and why those people think that they've got value. But once you've got things that have value and that some people have agreed on that there's value, then you're gonna have finance develop around that, right? And if you think about it, so say you were somebody who minted one of these Bored Apes early on, so maybe you minted two or three of them. You got them for free. Maybe you're a student. You don't really have a lot of money. All of a sudden, these things are worth $60,000 each. $100,000 each. More than that at the peak. These things are now probably a large portion of your net worth, but some of these people just don't want to sell them because they're so emotionally attached to them. They're kind of like, it's part of their identities. They've built brands around it. They never actually want to get rid of them. But it's a lot of value that they now, like, they're sitting on this value. They're kind of NFT rich, but like dollar poor. So they want to do something with this thing, with these assets, and that could be buying more NFTs. It could be do some other kind of trade on a decentralized platform or centralized platform. It could be, one of our users lost their job during COVID, and they basically took out a loan to pay the bills until they could find another job. So it's all kind of lots of different reasons why you would need to borrow them, to borrow money against them, and then. So yes, it's quite volatile, but NFTs are, especially the blue chip NFTs, aren't actually that volatile in Ether terms. And most of our loans are denominated in Ether, So if like CryptoPunks, their floor is basically not moved in the last 3 months. It's very, very, very flat. Like the high end art blocks, generative art stuff, that's up 20 or 30% even in the current markets. Two or three times in the current markets. In June last year, after the crash, Chromie Squiggle was going for 4 or 5 Ether, and they're 15 Ether today. So they're volatile if you look at the whole class of NFTs. But the top end assets that are like showing staying power are not quite as volatile. And then also the loans are very low loan to value. So you're probably seeing typically 30 to 50% of the value of the asset that you can borrow for a 30-day loan. And the longer the loan is, the smaller that loan to value ratio is. So lenders adjust their kind of risk profile by charging more interest and having lower loan to value ratios to be able to absorb a 70% drop in that asset and still not get a default.
It kind of sounds like NFTfi is like the eBay of NFT
You think of
loans
it as
in
an
the
eBay.
sense that you don't set the price.
Yeah, so if you're an asset owner, essentially when you list that asset, you're getting lots of different lenders competing to give you that loan. And they all kind of have their own risk profiles. And at the moment, for example, you could get a loan on a CryptoPunk for less than 9%. Sometimes down to 3% APRs, which is like way less than a credit card at the moment. And the reason for that is there are lenders in the market who think CryptoPunks are underpriced right now and can afford to hold on to the punk if they get a default. So they just think it's very low risk for them to lend on CryptoPunks right now, because even if they get a default, essentially they got the CryptoPunk for what they got the CryptoPunk for a discount on what they consider a cheap price at the moment. So they feel it's very low risk to do that.
So Stephen, talk to me a little bit about the defaults. I mean, how much of defaults are you seeing? Is that rising as the crypto market weakens? And you mentioned that some people don't want to part with their
Yes.
NFTs. Obviously, this is why they do it. But others, they're actually hoping for a default so they can grab your NFT. So yeah, talk to me about these defaults and liquidations. What's the process?
So we've seen, like, there's times where the default rates have spiked a little bit. It was mostly actually in like June, July of this year, kind of after the big crash happened. There was, a lot of of NFT projects dropped a lot in value. So across all of our assets, we've got if you go by number of loans, I think there's about 11% default rate at the moment. And if you go by total, by loan volume, so if you kind of adjust by the size of the loan, it's only around 9%. So the more expensive loans are less likely to default. And for a collection like Bored Apes, the default ratio at the moment is about 3.5%, 4% is pretty low. And we're even seeing people repay loans where the loan is higher than the floor price of the assets at the time, because these people don't want to, even though it would probably make financial sense for them to default on the loan, they've got an emotional connection to the asset and they're still willing to repay.
Okay. And can you pledge any NFT as collateral on your platform? If not, then what's the process you go by determining what can be counted as collateral, especially because the value of NFTs change so quickly, right? So what may be valuable, I guess, in this market may not be valuable. Jack Dorsey's tweet sold for I think it was 2 million, and then it was last valued at $280. So how do you figure out what can be used as collateral and the value?
Yeah, so we go through an approval process to allow projects to go onto our onto NFTfi platform, and we check for a couple of things in there. So any NFTs that you can do something to change their value. So for example, Decentraland is this idea of estates, and you can add NFTs into it, but you can take them back out again. Anything like that doesn't work on our platform, because you can put stuff in, get an offer, take it out, and then accept the offer, right? So like that's risky. So there's a few things that we need to check for, like, is this actually a suitable asset to be used as collateral in a loan? And then the other thing we do is we check that, is this actually the real smart contract for that asset? So when you see a CryptoPunk on our platform, it's a real CryptoPunk. It's not a fake CryptoPunk. So that's the other thing that we check. And we also just check that it needs to have at least a minimum value, because transactions cost money on Ethereum, and at some point the transaction cost is too high percentage of the actual loan. So there's like a minimum price that we look for, and then we look for at least 1,000 Ether of volume on the secondary market, so that we know lenders could at least get rid of that asset if they got a default. So that's kind of all we do, and we mostly approve things that are being requested from us. So as people in the community come to us and saying, "Hey, I'm looking for to get a loan on this thing," there are other people who are also collectors who are willing to lend to me on this. So the kind of the volume kind of comes organically, and then not all projects actually take off. Some of them, people just aren't willing to use as collateral because they just think they're too risky. So most of our volume comes from the top 10 projects, really.
So, and what are the range of interest rates on loans like this, Stephen?
Yeah, so like I said, the lowest interest rate we've seen on CryptoPunks is around 3%. Most likely you'll get under 10%, 8 to 9% at the moment on a CryptoPunk. But if if it's on something much less well known, much riskier, kind of a little bit less. Much less expensive, hasn't been around so long, you're paying quite high interest rates, 40, 50% sometimes even.
Okay. I was going to say it sounds a little bit similar to credit cards in terms of the interest rates. But to be clear, these are rates that it's a peer-to-peer marketplace, so people set these themselves. Correct?
Exactly. So we don't set them at all. It just depends on how competitive it is, how many lenders are trying to get loans on that asset, and how much confidence have they got in that asset. And we'll see, in the current, this month we've seen interest rate generally go up. They're much higher than they were last month, just because there's more risk in the ecosystem all around.
Okay. We have a question from the community, from the Discord community. They wanted me to ask you. I'll just read this to you. Stephen, when you lend out money, it has material value and serves an active use. NFTs started as a way for artists to make money, but not every piece has utility. Do you think the use case for NFTs would be a big driver, but also an obstacle for adoption of your lending protocol?
So I think so for things like art, holding it in escrow, you're not really losing the use of it. You can still see it there. If it's a utility asset, then while you're borrowing, while it's in escrow at the moment, you can't use it. But from early next year, we're adding a system where you can use those NFTs as if you own them while they are in a loan. So for it, all we do is stop you from actually moving it, but you can kind of still use it as if you actually still own it. And then I think art really is, I think the reason the art things are holding value so well is because art is kind of finished once you've done it. You don't have to rely on a team to deliver, and it kind of doesn't need very fast transaction times. So I think you'll see more utility as you see faster blockchains. You need probably more general adoption. Much more mass market. So yeah. I mean, I think over the long run, utility is going to be a large part of the NFT market, but I think art is still going to be a giant market all on its own. NFTs are just a unique digital thing and really can be anything. And I'm quite excited to see what all kind of becomes represented as an NFT over the next 5, 10, 15 years. So the more utility, the better. And we're working on solutions to kind of make utility still usable while using these assets in a loan.
Now, you're at NFTfi, loan volume has surged despite the crypto winter. I know part of that, Stephen, is that you first began offering this in June 2020. So with any new product, there's going to be an acceleration as people adopt it. But talk to me a little bit about the size of the market right now and where you expect it to be. And has crypto winter, has that stunted the growth? I mean, it would be growing anyway because it's from a small base when you're just starting in such a nascent industry. But has it stunted the growth a bit in terms that it could have exploded even more?
Yeah. So, I mean, first of all, just in 2019, anybody who was in crypto, in NFTs at the time, if you told them we would be where we are today, I think they would have all said you're crazy. So I think it's exploded in size faster than anybody in the space ever expected it to. Like nobody would have thought you would have celebrities changing their profile pictures and working for for NFT companies. It's just unimaginable for people that it happened so quickly. So just like wanted to acknowledge that fact, and then obviously the growth has slowed down compared to when everything was going crazy. But that's just how crypto works, right? It's like every 4 years there's like a bull run. There's way inflated expectations. People get way over bullish. Then there's a crash, and then all the tourists leave, but a few more people stay, and they build new stuff that fuels the next wave. So it's just how crypto like grows. So you kind of get used to it once you've been in the space for a while. And just to put it like context on the size of the market, when we started, we were the only platform that you could do this on. We did $300,000 in loans in 2019. In 2020, we did $40 million in 2021, and we've done $250 million so far this year. So it's growing rapidly. Now there's 4 or 5 other competitors that are kind of out there. We do between 50 and 60% of the volume on a week-to-week basis. So you add in another 40% on top of that. So the market's definitely growing. When we started the NFT lending volume, even like 12 months ago, the NFT lending volume was 0.5% of the volume of OpenSea, and we're now on 7% of the volume of OpenSea for the total lending market. And some collections like CryptoDefined are their lending volume is higher than their sales volume on OpenSea. So it's definitely like picking up. Would have definitely been faster if the bull run carried on, but it's like par for the course in crypto.
Do you have any expectations for how big the market will be in 5 years? I mean, any predictions on the size?
Yeah, it's a little bit hard for me to say kind of exact timelines, but if you look at the kind of in the real world, fungible, most things are fungible, so all intangible assets are fungible, all real estate are non-fungible, all real estate is non-fungible, all cars are non-fungible. So, in the real economy, non-fungible items are orders of magnitude more in terms of value than the value of like pure money. And I suspect we'll see the same thing. At the moment, most of the value, it's now under $1 trillion, but let's say close to $1 trillion of value in the fungible token market cap. I think at some point the NFT market cap will exceed the kind of cryptocurrency fungible token market cap. But that's once contracts and everything is represented as NFTs online. So very big is kind of my point. 50, 100 times where we are now in 3 to 5 years, I think is not unreasonable.
Interesting. Okay, so it's going to be much more commonplace in the crypto world than it is today.
Yeah, okay. And it's going to spread. I would say like one of the ways to think about NFTs in Web3 is, like NFTs are to Web3 like web pages are to Web2. They're kind of like the basic building block on top of which this new economy is being built. For the first time, up until NFTs came around, the only thing to do with crypto was make more crypto or sell it and buy something in the real world. And now with NFTs, all of a sudden, there's things that are crypto native that people want to own for the sake of owning them. And so even though there's this crypto bear market, all of the top collectors are still buying and they're still kind of trading with each other. And that core community is still just as active as they always were. And it's because they're collectors at heart and they want to own these things. And they're going to do that if the prices go up or if the prices go down. I mean, when the prices go up, obviously it brings more attention and brings in speculators. But there's a group of people that just like collecting stuff. And, for them, this is something that they, right now, that's the main use case. But over time, it's going to spread to pretty much everything.
Okay. One last question for you. This is all really interesting. And it'll be very interesting to see what happens in a year or two, as you mentioned. So last time we talked, Stephen, you had mentioned that NFTfi is in the middle of designing its own token, and it's part of your goal to build a decentralized, permissionless system. You talked about how it's important to test the token under different circumstances. And I thought that's very interesting considering what's happening today. And you had mentioned, testing the token to see, at what point could it go to zero? What happens if volume goes up, for instance, and price goes down, which is unlikely in most scenarios, but what happens and what happens to the business? And this lesson is very relevant considering what's happened with FTT. So could you talk a little bit about how you tested your token and why that's important?
Yeah, so this goes back to kind of when people say this wouldn't happen in like DeFi, right? So yes, people won't steal your money because they can, but you might put your money into a system like Luna that was like, had this failure mode where all of a sudden within a day the price just drops to basically zero. So the problem with these crypto systems is they're very complex, and actually mathematically they're called complex systems. And there's actually like a huge body of research on designing complex systems. And this research is mainly used in like designing fighter jets, designing like aircraft carriers, nuclear power stations, that these incredibly complex systems that are very hard to predict exactly how they're going to act. But there's a whole branch of mathematics where you can kind of essentially say, well, we don't know exactly what's going to happen, but this will never happen. Like the nuclear reactor will never go into meltdown. There's no scenario where that's possible. And you can adapt a lot of those techniques and apply them to crypto economic systems. So this whole thing was pioneered by a company called Block Science. We worked with a company called CAD Labs, which a lot of people come from the block science world, and they're essentially using these mathematical scientific techniques to basically say, well, we can't tell you that what your token price is going to be, but we can tell you in our scenario, like as part of the process, there was one scenario where if we kind of kept getting new customers and the volume on the platform kept going up, but for some reason the token price kept going down, there would be a scenario where that would be really bad for the system. So we could then see that in the model, and then we could design a system that basically stopped that from happening. So we basically then say, okay, well, now this can never happen again. And in the same way that we want when somebody designs a bridge, there's some professional standards that you need to adhere to on like what the tensile strength needs to be on the bridge. We could, as an industry, develop, some of these things and say, okay, before you're allowed to going to list the token on a decentralized exchange, you need to have run at least this set of simulations and proven the following. You won't always catch everything, but it would reduce your risk significantly.
And your point was, and you made a very good point, like if we had tested this with the Luna Terra ecosystem, FTT, or maybe they did, I don't know what tests they ran, but with a lot of these tokens, if you test it and know under what circumstances it could go to zero and how it could affect the business, could avoid a lot of these basically catastrophic meltdowns. Correct?
Or at least to disclose those things, right? So in the case of Terra, there were lots of people that pointed this out and said, hey, if you start running in the situation where your token price keeps dropping and you start printing more Terra to prop it up, that is going to lead to the price going down to zero. And then, the response from the Terra community was, well, that's never going to happen. That's not very likely, right? So, so I think at the very least, these things need to be transparent. And then, some people, people need to decide, are these things likely to happen? Because sometimes those things really are crazy, unlikely scenarios. And it is not, in our scenario, it was very easy for us to stop that from happening. But sometimes there's just trade-offs where you kind of take this risk in a very rare scenario because it gives you something else. But at least those risks should be disclosed and people should understand what they are.
Right. And that could be part of a regulatory regime or self-regulation by the crypto industry. But I think that's a very interesting and good point, Stephen. Well, Stephen, thank you so much for being here today. That's it for today's edition of Crypto Defined. Check out TruthDAO.news in the next few days. We'll have a written recap of our interview with Stephen Young, the CEO